Hi guys, today we're going to look at two stocks which could be good in the reopening of the economy. I wanted to check three things. One, that they are high growth stocks. Two, they've pulled back recently. And three, they're a good recovery play. The first stock is called ChampionX Corporation, ticker symbol CHX. ChampionX Corporation is a global leader in oilfield technology solutions, drilling technology and automation technologies for the oil and gas industry. You can see the steep pullback back in March, which was a result of the pandemic. Oil demand fell off a cliff as the economy abruptly stopped. ChampionX could be a good reopening play. If vaccination campaigns are successful and demand comes back quickly, the market may get very tight in the second half of next year, sending oil prices higher. It's also pulling back to a trend line, and if we look at XOP, which is an oil and gas ETF which tracks the drilling sector as a whole, we see a similar story, a recent pullback in an otherwise clear uptrend. Energy has been one of the market's least attractive sectors for the last decade, so it could finally have its day, and investors are bidding the price of the stocks up. This is because prices are driven by expectations more so than immediate realities. The oil market was also bullish because OPEC recently made a decision to delay production increases. This of course could change at any point, so you'll have to expect pretty volatile prices this year, as the market is uncertain about a lot of factors, including whether or not we'll have another lockdown. ChampionX has seen solid earnings estimate revision activity over the past month, which suggests analysts are becoming a bit more bullish. You can see quarterly earnings really took a beating in the first quarter, but it's picked up steadily since. And if we look in the yearly or the annual, revenue has been going up year on year. Of course, we have the dip due to the corona. ChampionX is unprofitable, but it has sufficient cash runway for more than 3 years due to free cash flow being positive and growing by 15.8% per year. And based on 9 analysts, their earnings are forecasted to grow 120.3% over the next 1 to 3 years. Another reopening stock to watch is Winnebago Industries. They are a leading North American manufacturer of outdoor lifestyle products such as motorhomes, travel trailers and boats. Again, we've had a decent pullback in a solid uptrend. This is the March COVID crash, and since the lows here, it's up 370% to date. It's a solid company. Its average annual earnings growth over the last 5 years is 15.2%. And you can see it's been beating earnings estimates, and it's got very strong revenue growth with strong buy recommendations as well. In fact, earnings are forecasted to grow 20.53% per year, and their debt is well covered by their operating cash flow. I've overlaid their current PE ratio over their stock price, and it's nice to see it's relatively low, which is great for a growth company. For those who don't know, a PE ratio is the ratio of a company's share price to the company's earnings per share. It's used to find out whether a company is overvalued or undervalued. Of course, there's no standard correct ratio. Different industries have different PEs. A high PE ratio could mean that a company's stock is overvalued, or that investors are expecting high growth rates in the future. Winnebago Industries' PE ratio is 24.8, which is below the auto industry average of 38.4, which is good. It implies value. As an example, here's Tesla, which is a very rapid tech growth company, and you can see their PE is above the current price. People are still expecting high growth, and an Adobe PE is currently very fair valued, so it just gives you an idea. One negative is that there's been significant insider selling over the past 3 months. The biggest sale of Winnebago Industries from an insider in the last 12 months was made by Donald Clark. He recently netted about $12 million selling shares at an average price of $61.3. Insider ownership is 3.8% of the total market cap. That would equate to about $100 million. and insiders have sold $18 million worth in the last 12 months. So that's not great, and it's generally not good to see too much insider selling. But the sale, that big sale from Donald Clark, took place at a high price at the time, so it could be profit taking. It's worth just keeping an eye on that. And as always, this is not a recommendation to buy. There's a link in the description to help you do more research if you want to, and never risk more than you can afford to lose. Thanks for watching, and I'll see you in the next one.